Welcome back. Today we're diving straight into a brand new explainer. And man, we have a truly fascinating corporate action to unpack. We're doing a rigorous forensic analysis on the highly anticipated Marg Techno-Projects 2026 rights issue. If you've been watching the small-cap financial space, this one has absolutely crossed your radar. It's a move packed with grand ambitions, staggering numbers, and honestly, some pretty complex math. Our goal today is to serve as your ultimate investor guide, separating the hype from the hard data.
Okay, let's dive into this. Here's our roadmap for today. We're going to cover the massive 63 crore issue itself, their big pivot into BNPL, a look at surging profits versus their debts, the impending dilution threat, a quick peer comparison with Ganga forging, and then wrap it up with our final takeaways. Let's get to it.
Starting right off with Section 1, the 63 crore issue. To really grasp the gravity of this move, we first have to look at the sheer scale of the capital they're raising.
Now, the absolute headline grabber here is a 9-to-2 entitlement ratio. Yep, you heard that right. Marg Techno-Projects is offering 9 rights shares for every 2 fully paid-up equity shares you currently hold, at an issue price of 10 rupees per share. In plain English, for every 2 slices of the company you own, they are printing 9 more. In the corporate finance world, that is a staggeringly aggressive issuance for a small-cap entity. They aren't just raising a little bit of working capital here. Actually, scratch that. They're fundamentally expanding their entire share base to pull in up to 63.90 crore rupees.
And there's actually been a critical update to the timeline you need to know about. So the record date to be eligible was June 20th, and the issue originally opened on June 29th. But, and this is a big but, the board recently made a pivotal decision to extend the closing date. They've pushed it out to July 28th. This basically gives shareholders a bit more breathing room to either exercise their rights or renounce them on the open market by July 22nd. The final listing is expected right after that, on July 30th.
Moving on to Section 2, the BNPL pivot. Okay, so we know the when and the how much, but what is the strategic why behind all this money?
Well, Marg Techno-Projects is undertaking a massive operational shift. Historically, this company had its roots in IT and software development consulting, but they're completely pivoting away from that legacy. The future they're building, it's entirely focused on financial services, specifically scaling up their non-banking financial company or NBFC operations. And even more interestingly, management has announced they're diving headfirst into the fiercely competitive Buy Now Pay Later, or BNPL, and short-term personal loan segments on a pilot basis. They really want to be a serious fintech player.
And their planned capital allocation brilliantly illustrates exactly how serious they are about this pivot. Out of that 63.90 crore rupees they plan to raise, an overwhelming 61.90 crore is earmarked directly for NBFC loan disbursements. The absolute lion's share of this capital is meant to be the pure fuel for their new lending engine. Only a tiny sliver, about 2.60 crore, is set aside for general corporate purposes, which is, probably just to keep the lights on and the coffee machine running.
Next up, Section 3, surging profits versus debt. Now that we know their fintech ambitions, let's actually look under the hood at the financials to see if the engine can handle it. I've got to say, the growth trajectory here is genuinely eye-catching. For fiscal year 2026, the company reported an impossible-to-ignore 140% jump in net profit, bringing it up to 0.99 crore, which is a massive leap from just 0.41 crore in FY25. Alongside this, their total assets expanded aggressively from roughly 35 crore to 62.35 crore, and that was driven almost entirely by a surge in loan disbursements. So on the surface, at least, the lending business is booming.
If you're looking to build a bull case for this investment, the underlying metrics are your ammunition. Their return on capital employed, which is essentially a measure of how efficiently they use their money, sits at a very strong 21.40%. To support all this lending, their capital adequacy ratio, or CAR, think of it as their financial safety net, is incredibly robust at almost 60%. But perhaps the most reassuring thing for retail investors? Promoter conviction. The promoters hold a 48.35% stake, they haven't sold a single share recently, and they've publicly stated they'll fully back the rights issue, literally absorbing any unsubscribed shares themselves.
All right, Section 4, the dilution threat. Let's pivot sharply here. Every investment has risks, and for this explainer, we really need to put on our forensic accounting hats to uncover the potential downside.
We have to ask ourselves, what is the true hidden cost of such an aggressive share issuance? Remember that 9-to-2 ratio we talked about? Well, when you flood the market with that many new shares, the pie doesn't necessarily get bigger right away, it just gets put through a slicer. Here's how that translates into a pretty stark mathematical reality.
Because 2 original shares are turning into 11 total shares, you get a massive 5.5x dilution factor. Because of this, the estimated fair value of the stock post-dilution basically plummets to just 13.79 rupees. Compare that to a pre-issue market price that was sitting well over 30 rupees. That is a brutal mechanical adjustment that current shareholders absolutely have to factor into their portfolios.
And honestly, the dilution isn't the only neon red warning sign flashing on the dashboard. The stock is trading at an astronomical price-to-earnings ratio of roughly 134, a massive premium to its historical average. Furthermore, while the return on capital is good, the return on equity is, frankly, a sluggish 3.27%. Add to that a debt-to-equity ratio of 1.75, which has actually triggered forensic warnings in our source data regarding their ability to comfortably service those current debt levels.
Let's look at Section 5, benchmarking Marg versus Ganga. To truly gauge a rights issue, we shouldn't just look at it in a vacuum. Let's introduce a peer benchmark to give us some much-needed market context.
When we structurally compare this with Ganga Forging, which is a company running a concurrent rights issue right now, the differences are glaring. Ganga's offering a pretty standard 3-to-2 ratio, while Marg is pushing that extreme 9-to-2. Plus, Marg's issue size is nearly double that of Ganga's. Basically, Marg's capital call is significantly larger and far more dilutive to the retail shareholder than average market offerings.
But to be perfectly fair, we also have to compare the fundamental momentum here. Despite Marg's heavy dilution risk, its underlying business growth trajectory looks far, far healthier. While Marg grew its profit after tax by 140%, Ganga Forging saw its profits completely collapse, dropping by nearly 700% into negative territory. Marg also boasts a stronger net worth. So yes, Marg is asking for way more capital, but they're doing so from a position of recent operational strength.
And that brings us to Section 6, our final takeaways. We've looked at the ambitions, the raw numbers, the risks, and the peers. Now let's synthesize all this data into some actionable insights.
So the crucial point is really this. As an investor, you are weighing 2 incredibly powerful, opposing forces. On one side, you've got a highly motivated management team executing an exciting pivot into BNPL fintech, backed by a 140% surge in recent profits and total promoter confidence. But on the other side, you face the harsh mathematical realities of buying into a stock with a 134 PE premium, all while staring down the barrel of a 5.5x equity dilution that mathematically slashes the fair value of the shares.
Ultimately, it all comes down to execution. Can this management team deploy almost 62 crore rupees into the hyper-competitive personal loan market efficiently enough to outpace the massive dilution they've just created? Is Marg's BNPL dream actually worth the price of a 5.5x dilution to your portfolio today? Well, that is the ultimate risk-reward question you have to answer for yourself before the July 28th deadline. Thanks for joining me on this explainer, and as always, keep digging into the data.